Welcome to lesson number 2, what the infinite banking concept is. In this lesson, you will learn the fundamentals of the infinite banking concept as conceived and taught by the creator, R. Nelson Nash. I'm going to start this lesson by showing you what I tell people in person when they ask me, Carlos, where do you put your money? In talking about the alternate bank, of course, I have a lot of people walk into my office, and what people want to know is, Carlos, where do you put your money? You know, they want to know, where do you put your money? And I'm going to be honest with you, I'm getting better at it, but I'm embarrassed to tell them. I can't do it still comfortably because I think they're going to think I'm crazy. And so I kind of beat around a bush a little bit. And so I said, well, do you like to invest? And they say, oh yeah, I'm an investor. I said, well, you know, savings and investing, you do know it's two different things. So, oh yeah, I'm a savvy investor. I said, well, look, I may have something that you might like, but let's just get an idea of what kind of things you like in an investment. Let's tell me about what is the ideal investment for you. What sort of things do you like to have in it? And the first thing they always come up with, and they say, I want a high rate of return. And of course, we all do. And I say, okay, well, that's a good start. What kind of rate of return? 20%. Okay, you wonder, what world are you in? I mean, you know, 20%. Okay, let's put it down, 20%. What else do you like? Well, then they start to name things that we all like in an investment. You know, they want liquidity. They're talking about being able to get out of the investment if it's not working for them. So that's a good one. They want guarantees. If you're going after the ideal investment, you want it to be guaranteed. Obviously, safety goes on the list. I'm making notes. I'm writing these things down. They want tax benefits on the investment, of course. And I will suggest, well, just tax benefits, or would you like for it to be tax-free? Oh, yeah, that's better. Tax-free. Okay. Oop. So, and they don't want any market volatility. So they want a 20% return, they're saying, but I don't want to be taking risk in the market. I don't like any of this. But it does make sense. Who wants that? So they don't want any market volatility. They want creditor protection. You know, they read about that all these qualified plans, they're protected. And they all want the same kind of thing. And especially, you know, I've got a lot of money. You know, I don't want to be some, you know, hotshot attorney, you know, going after my assets and ruining me. So I want creditor protection. And of course, they want it to be inflation-proof. So up to this point, it's easy for them to list these attributes of their ideal investment. In the next line, it starts to get a little bit more difficult. I start to help them out because we are building the ideal investment. And I said, would you like to have control of the asset? And they stopped there. What do you mean control? I said, well, think about it. Wherever you invest your money, do you actually have control of it? Well, not really. You know, you got somebody managing it, you know, and that sort of thing. I said, well, would you like to have control over it? I said, well, I think that would sound ideal. Would you like to be able to transfer it to the next generation without having to go through all these loopholes or, you know, tax situations? I love that. Would you, if you could control the asset, would you like for it to be easy to manage? You don't need a manager. You can do it yourself. He said, well, yeah, now the control of the asset makes a lot more sense if it's easy to manage. Okay, well, let's write that down. How about low fees or no penalties? See, a lot of these people that come to me are thinking either hedge funds or they're talking about, you know, AAA rated mutual funds, you know, that sort of thing. But they've come to realize there's huge fees in these things. They're eating up all the profit here on the thing, so they don't like them. Now this one goes up because at about this point, the individual will stop me and say, wait a minute, this is sounding a little bit too good to be true. So don't get me wrong, I don't want to get into something that's illegal. And I said, in other words, okay, so you want it to be reputable, right? Yes, I don't want you to think I came in here looking to get, no, I understand. So let's write that down. You want it to be very reputable, okay. This one is the one that I point out, or I say, would you like for it to be private? This one really stumps them, because what do you mean private? Well, I said, what I mean is that you don't have the government looking over you all the time. Have you ever noticed that you invest in something, there's a 1099 coming at you every year? How would you like to not have 1099s and it'd be private, where the government doesn't even know, basically doesn't even pay any attention to it? He said, that would be ideal. I said, and they're looking at it, see, and they're looking at the list, and they're thinking, and when I tell them that what they just described is dividend paying whole life, they are shocked. You are kidding me. This is dividend paying whole life? Yeah. Wait a minute. You said it had a high rate of return. I mean, all I've ever heard, not only that's the worst place to put money, but I mean, there's no rate of return in there worth anything. And I say, well, look, if you look real carefully, you'll see that a lot of these companies are giving you, some of them say 4.25%, some maybe a little higher, 4.5%. But since it's growing tax-free, the tax equivalent of that is another maybe 1.5% to 2% higher than that. So if you're at a high tax bracket, you could be getting a lot more. So that's not bad. It's not a bad rate of return. But look at it in comparison to everything else you're looking at. Besides, let's just say you've got $1 million policy and you make your first premium payment, and then you drop dead the next day. Your beneficiary is going to get $1 million. You want to calculate the rate of return on that? It's huge. So yeah, it does have a high rate of return. This is the picture that I present, and the whole thing about it, it's not even an investment. It's life insurance. That's what it is. That's the alternate bank. That's the means for the alternate bank. But that's not IBC. You need to understand that. This is the means. This is what goes in here is the alternate bank. IBC is the process, the action that you as the owner, the banker, do. That's what IBC is. Now that I've hopefully piqued your interest, let me explain to you very briefly what IBC is. IBC is the abbreviation for the infinite banking concept, discovered by R. Nelson Nash and explained in this slender volume, Becoming Your Own Banker. The financial problem facing the typical household is that they've given control of their cash flow over to outsiders. For example, the typical employee will plow all of his savings into tax-qualified retirement accounts, where his money is effectively in prison. So when this employee needs to buy, say, a car or pay for a wedding, he has to go out and borrow the money from outside bankers. The problem here is not only the interest that you must pay to borrow their money, but also the loss of control. If you fall behind on your car payment, for example, eventually the bank comes and takes away your car. The solution that Nelson discovered was to become your own banker. What he meant was that you should set up an alternate warehouse for your money, a place to store it where you could tap it when those big ticket purchases come up. The specific vehicle or platform that Nelson recommended for IBC was a dividend-paying whole life insurance policy. In future videos, starting with the next one from Bob, we will explain very carefully how IBC works. But for right now, let me just explain it in this brief way. When you make premium payments on your whole life insurance policy, what's called the cash surrender value keeps rising. This number is how much the life insurance company would pay you to shut down the policy. But it also shows you how much you can borrow against your life insurance policy. Guaranteed. So, this is IBC in a nutshell. You see, what Nelson Nash wants you to do is to use your income and use it to help build your own personal bank using a whole life insurance policy. As the cash value grows and as it permits, you use it to finance your major purchases. Rather than going out to a conventional financial company to buy your next car, instead, you take out a policy loan against your life insurance policy. Then, over time, you pay back the policy loan just as you make your own normal car payments. But the advantage with IBC is that you're always in control. If you lose your job, you can stop paying back the policy loan to the life insurance company, and they don't mind. Nobody's coming for your car because you paid cash for it when you first took out the policy loan. Now, there are several other strong advantages to IBC, such as tax benefits when you design and use your policy in the correct way. But I don't want to overwhelm you now. There will be plenty of time for us to review these finer details as the video series continues. Now, for his part, Nelson said that the whole point of IBC was to return the banking function to the you and me level. Now, the strategy of the entire financial services industry, I think, is completely warped. I mean that because it's based on the accumulation of money principle, like I showed you in Investor A and Investor B. The whole thing is that. So this includes all three of the big sectors out there: insurance, Wall Street, and commercial banks. I'm eliminating or pulling out of there the mutual holding companies, and then they work for the policyholders. But predominantly, insurance company wants you to give them their premium payments. In Wall Street investments, they want their money into these investment accounts, and commercial banks wants you to put their money into their coffers, and it's all about accumulating money. There's an enormous amount of money in banks, just sitting in banks, and they're not earning anything, but a ton of money goes in there, okay? Now, the IBC strategy is just the opposite. It's about the utilization of the money, completely opposite. And we do it through policy loans, which is in our contract of these policies, the IBC policies. And what do we use it for? Well, all of life's major purchases, because people are so strapped for money They've got money that's out of their control and they can't come up. So they wind up going into debt to buy cars, to pay for weddings, home repairs. They just go into debt. So they don't have the actual accumulation. But the idea of the IBC is to use it for all these major life purchases. And you can even use it to eliminate debt. So it's about the utilization of the money, not the accumulation of it. The financial services industry it's making you put your money in prison. You can't touch it without penalties, tax, all this sort of stuff. So the IBC policy with the control that he has in his policy, you got superior cash flow management, you got these special terms, you got tax planning options, you got passive income at retirement. I mean, it just has an abundance of benefits. And so that's the key and the difference between the two. So what I've tried to explain here, both by what we saw here in regards to businesses, as regards to individual, that IBC is really about a different warehouse to store your money. We are forced to use the commercial banking system as our cash flow system. Think about it. That's where we go and put our checks. That's where everybody puts their money in the commercial. We're forced to go there. It's about financing more than it is about insurance. Financing, that's more important. And it's for all the big ticket purchases of life. So this is why these policies are focused more on the cash value and not so much on the death benefit. But the death benefit is there, and it's a huge asset. But the focus is on that cash value, you see. It's ideal for cash flow management, we've already said. But the thing to remember, it's not literally a bank, you understand. It's not like a bank out on the street that we see. It's not literally a bank. But we are using a specially designed life insurance contract to practice a form of privatized banking. Thank you.